everyone, my name is Emily. In today's video, we are going to talk about the scalping strategy. Scalping is a forex trading strategy that involves opening and closing multiple positions on one or more forex pairs over the course of a day, usually in seconds or minutes. Instead of opening one position at the start of a trend and closing it at the end, scalpers will open and close several positions over the course of a trend. Scalpers usually hold a position for a very short time, getting in and out of a trade within minutes if not seconds. The aim of scalping is to gain just a few pips at a time, looking for multiple small gains rather than fewer larger ones. Scalpers often use CFDs to trade forex pairs that are rising or falling in value. They will open a position to buy if they think the price will rise and open a position to sell if they think the price will fall. The short intervals between trades and the speed of the scalper working with price differentials enables trades to have less exposure to risk overall. In addition, if the trader is very disciplined about cutting their losses on losing trades, their risk is reduced even further. CFDs, which are leveraged products, also enable traders to open a position with a deposit called a margin. This can magnify profits but can just as easily magnify losses because your profit or loss are calculated from the full value of the position. That is why it's so important to have an appropriate risk management strategy in place no matter which scalping techniques you're using. Basically, in order for a scalper to make a significant amount of profit, a larger position size is usually required to make the trade worthwhile. But scalpers must be very careful to avoid high volatility when trading in the forex market and to have a reliable broker that offers minimal recalls. Thank you so much for watching us today, guys. Stay tuned for more educational videos. Bye-bye.
Now, if you've just joined, we're going to be talking about how you can set up your trading journal and a couple of important pointers as well. So before we get started, as per usual, a risk warning: our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suited for everyone, and you should ensure that you understand the risk involved. A disclaimer: the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. Redistribution. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. So I'm Melanie. I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019 to 2021. Okay, so here's our agenda for today. We're gonna talk about how you can get the most out of your My FX book. We're gonna talk about optimizing your strategy. So what's the best days, best times, best techniques as well. And also we'll be talking about the best direction. So how exactly you can do a bit of trend trading. Okay, let's get started. So what exactly is a trading journal? So it's basically like a diary, and it's a way for you to track your trading performance by recording all of your trades. So you can start a manual or an Excel sheet, or an automated trade journal. And I'll show you guys some examples in a little bit. So importance of a trade journal. So before we dive into the specifics, let's quickly touch on why exactly having a trade journal is crucial. So trading journals, as we mentioned earlier, serves as your personal trading diary. So it helps you to track your trades, analyze your performance, and ultimately improve your results over time. So some points on why exactly you should start using a trading journal. Firstly, is to track your progress. So it basically provides insights into your performance and helps you to identify patterns in your trades. This also helps you to learn from your mistakes because you're recording your trades and understanding the reasoning behind them so that you can learn from your mistakes, avoid repeating them in the future. Okay, so this self-reflection is crucial for continuous improvement as a trader. Next is to develop discipline. So maintaining a trading journal instills discipline in your trading approach because it encourages you to stick to your trading plan and avoid impulsive decisions by holding yourself accountable for your actions. So I'm sure if any of you guys have ever traded, you will know how difficult it is to really maintain and stick to your trading plan, especially when it's not going according to your plan. Okay, so next, evaluate strategies. So you can identify which strategies are working well and which ones need adjustment or refinement. So this helps you to basically evaluate the effectiveness of your trading strategies. Manage emotions. So emotions can significantly impact trading decisions. So as I mentioned earlier, when a trade doesn't go according to your plan, um, having a trading journal basically helps you to manage those impulsive emotions by providing a structured way to review your trades in an objective manner so that it reduces the influence of fear or greed on your trading decisions. So this also helps you to set realistic goals and track your goals so that you can stay focused and motivated. Improve decision making. We kind of talked about this already. Enhance accountability. So when you're keeping a trading journal, it encourages transparency and honesty with yourself about your performance, fostering a culture of responsibility in your trading approach. Okay, so let's look at My FX book. So My FX book is a powerful tool for tracking, analyzing, and sharing your trading results. So from setting up your account to utilizing advanced features, we'll talk a bit about how to leverage My FX book to its fullest potential. Okay, so let's start off with what should you monitor in your journal. So typically, a trading journal should include the date and time of your trade, basically the open as well as close, the instrument being traded, so whether it's dollar yen, euro dollar, gold, WTI, position size, yeah, and then direction, whether you're going in for a buy or a sell, entry and exit points, trade result once your position is closed, profit and loss at an absolute level as a percentage of the account size, and your risk and reward. So how can your journal improve your trading? So we briefly talked about this earlier, but basically, since you are able to review your trading activity over various time frames, so daily, weekly, or monthly, it will allow you to find the right trading style, whether you are a swing trader, position trader, intraday, or scalper, and identify your strengths and weaknesses, improve your risk management, as well as have discipline. Okay, so how do you set up your trading journal? Basically, you first have to choose a format, decide on what categories you're going to be trading, followed by capturing trade details, analyze trade performance, reflect on the emotional factors, review and adapt, and maintain discipline. Okay, so these are some of the skills that you will be developing when you set up your trading journal. Performance analysis, learning and development, emotional awareness, risk management, trade planning and execution, accountability and discipline, and confidence building. Okay, so let's talk about these examples really quickly. Okay, so there are a couple of examples that we've included here about how to create a forex trading journal. So this example is in Excel. So by using an Excel spreadsheet, this example over here, so all of these are automated. So this one is manual because obviously you have to type in the data yourself, as you can see in this example here. Okay, but yeah, so this will basically look like this is what your spreadsheet should look like. With the initial, maximum, the date, the profit and loss. Yeah. Okay. Yeah, and then for automated tradings, you can read this website as well. Okay, there are some which are free and some that you have to pay for. Okay, so the manual option is obviously free since you have to set up the table yourself. So it's really up to you and your own trading strategy. Okay, so you can go ahead and take a look at these two websites. Yeah, I'll go ahead and pop these two websites in the chat as well. So the one that I'm popping into the chat now is the manual one. Okay, and then the automated one is over here. So I won't go too in-depth into how to set up your automated trading journal because I think if you go into the website, it will tell you exactly how to do it. So yeah, let's just move on. You can also look at Forex book. Okay. Yeah, so these are just some of our recommendations. Of course, it's completely up to you and your objectives when you're deciding whether which of these to choose from. But yeah, these are just some of our suggestions. Okay. Okay. Let's move on. So let's talk a bit about optimizing your strategy. So a trading journal is not just about recording your trades, but also about analyzing them to identify patterns and areas for improvement. So let's talk a bit about some strategies for analyzing your trades and refining your approach for better results. So firstly, let's start off by talking about the best times to trade. So market volatility happens throughout the week and it varies. So we're going to talk about which days tend to have higher volatility and better trading opportunities. And we're also going to introduce economic calendars and how you can utilize them to identify when market volatility is the highest. Okay, So let's look at um, what exactly is an FX news calendar. So firstly, on the left, over here, we have investing.com. And on the right is forexfactory.com, which is the one that I typically prefer to use. Yeah, but they're basically about the same. They give you the dates that you're looking for. You can filter the dates. So if you're looking at this week's economic data releases, you can just filter it to look at this week or this month. And then as you can see from these little colored calendars, it also filters by low to high impact events. And it gives you the forecasted values, the previous values, as well as the actual values once the data is released. Okay, so these FX news calendars are important because it allows you to see at one glance all of the important economic data releases. And these data releases often create more volatility in the markets. So it's important to take note of them. So it shows you the key events such as the GDP, CPI, NFP, crude oil inventories, and even central banks' monetary policy meetings. Okay, so let's understand some high impact events. Firstly, we are looking at the US. So FOMC meetings are the Federal Open Market Committee, and this is the US Fed's way of communicating their view on monetary policies. So these normally come together with a Fed interest rate decision. So if the Fed is dovish, the USD is bearish, and if the Fed is hawkish, the USD is bullish. If interest rate goes up, the USD is bullish, and if interest rate goes down, the USD is bearish. Okay. Next we have NFP or non-farm payroll, which measures the change in citizens that are employed from the previous month, excluding the farming industry. Unemployment rate measures the total unemployment of workforce that is seeking active employment from the previous month. Okay, and now crude oil inventory. So these measure the weekly change in the amount of crude held by US firms. So if crude inventories increase, they are inversely related to oil prices, so we can expect oil prices to drop. EIA is Energy Information Admin, and this is a short-term outlook. So it's basically the monthly forecast for the year ahead, the demand and prices across major fuel types. Okay, so some benefits of using the FX calendar. Depending on your individual trading style, it can help to plan trades and allocations for the day, week, or month ahead. And it also helps to alert the individual to upcoming important news events that may affect volatility. Let me know if you guys have any questions so far. Hey, if there are no questions, let's move on. Okay, so now we are getting into kind of the fun part. We're gonna talk about some of our favorite techniques, or just some techniques that you should maybe take note of. Firstly, of course, I'm just gonna touch really quickly on this because we recently finished our Fibonacci series. So if you missed that, I think it's probably uploaded on YouTube, but if not, you can email IronFX on their website and they will probably send you the recording or give you the link. Yeah. So I'm just going to briefly talk about the checklist and what things you should look out for. Okay. So for Fibonacci, there are a couple of steps. Firstly, is the market structure clear? So you want to look for big zigzags. And we want to see, a very clear market structure, so a clear up or down. Okay. Yeah. So next, identify the recent trend. So are prices going down or up? So it's important to always follow the general trend. Next is to identify recent major swing lows and recent major swing highs. And lastly, connect the two extreme points from the highest to lowest for a downtrend and the lowest to highest for an uptrend. Okay, so let's move on. Next, which is quite important, is your take profit and stop loss levels. Okay, so for your take profit and stop loss levels, it's important to place your stop loss beyond a key confluence level, or if you look here, a key major resistance level. So in this case, we are going in for a sell since our take profit is below. So since we're going in for a sell, we will place our take profit before any levels. So in this case, it will be above any major support level. And for stop loss, we will place it beyond any major resistance level. So in this case, we're placing it above. Okay, so the reason for this is because price is attracted to such strong areas of Fibonacci confluence, or even if it's just multiple swing high levels that line up in the same area, that's also a major resistance area. So price is attracted to these areas. So if your stop loss is right before these areas instead of beyond it, you will most likely get stopped out before the market reverses. So like you can see over here, we would most likely get stopped out if we had placed the stop loss slightly below. Okay, for take profit, we typically recommend to place your take profit before a key Fibonacci confluence area, because when price reaches any significant area, there is a high chance that it won't be able to go beyond it. So instead of reaching your profit target, it reverses back to your entry, or even worse, your stop loss. And this is one of the reasons why people complain that the market is being manipulated, because they might miss that take profit by 1 or 2 pips. Okay? So now let's talk about another technique, which is the trailing stop loss. So in our previous slide, we talked about, we go back. So this is kind of a fixed stop loss template. So if we talk about trailing stop loss, it's a type of stop loss that is set at a certain percentage or dollar amount away from the market price. So the idea behind a trailing stop loss is to lock in profits while giving the trade room to breathe. So basically, it means that the stop loss basically follows the market price as it moves in favor of the trade. So the example I have here is we're talking about stocks, but the idea is pretty similar if we're talking about currency. So let's say you buy a stock at $100 and you set a trailing stop loss at $10. As the stock price rises to 110, the stop loss will follow, now at $100, since 110 minus $10. So if the stock price drops to $100, your stop loss will trigger, selling your position and protecting your profits. The trailing stop loss technique can be useful for traders because it allows them to manage risk and lock in profits dynamically as the market moves. So this is different from a fixed stop loss, which is set at a specific price and does not change as the market moves. So it's important to note that a strict trailing stop loss is not a guarantee that you will exit the trade at the desired price. Market conditions such as gaps or rapid price movements can trigger a stop loss order before it reaches the desired level, leading to an unexpected exit from the trade. Therefore, it's important to use trading stop loss in combination with a solid risk management strategy. Okay, I just realized I didn't show you guys the FX news calendar that we like to use. So let me do that now. Okay, so earlier I talked about Forex Factory being one of the FX news calendars that we like to use. So if you click on the date, so when you go into the page, it looks like this. And clicking on the date, you can select this week, apply settings, and you get the whole list of news events for this week. So if you click on this green icon, you can see that I've filtered it to only the high and medium impact events. But you can select all, you can filter out the currencies that you're looking at and the different event types, apply filter. And yeah, you can see once the actual result is released, it will update. But it will also give you the forecasted values, predicted values, forecasted as well as previous values, and the currencies as well as the different times. Okay. Okay. Also, if you weren't here for the Fibonacci webinars, you can also go onto forexalme.com over here. Okay, and you can click on trading guides. How to draw Fibonacci retracement correctly, and it gives you a pretty in-depth explanation on how to draw Fibonacci's. So we have a couple of videos for you to watch as well. What to look out for, unclear and clear market structures. Yeah, what to look out for, checklist. Yeah. So there are also different techniques for Fibonacci. So we're going, I think in this guide we go through each of them. So we have retracement up above there, as well as the different other Fibonacci techniques. So here we are combining them in order to find Fibonacci confluence levels. Yep, so feel free to go ahead and take a look. Okay, let's get back to my slides. Okay, so let's look at the different methods of trading stop loss. So here's a summary of the different types of trading stop loss methods that we'll be going through today. Just really briefly, firstly is the moving average indicator, followed by parabolic star, chandelier, ATR indicator, support and resistance levels, and a combination of these methods. Firstly, we'll start off with looking at the moving average. Okay, so you can see that using our MA, the trading stop loss is triggered when price basically breaks out of it and moves above the moving average. So I think that's pretty straightforward. You can see in this example as well that it got us out before price started to increase. If we look at a trend line breakout, okay, actually this line here is kind of a trend line breakout. The only issue why we can't call it a trend line breakout is because trend lines have to have a minimum of 3 touches in order to be considered valid. And you can see in this case, we only have 2, okay, before price broke out of the trend line. So when price breaks out the trend line, that's typically a sign that price is going to move in the opposite direction, which it did. So when it moved in this downtrend, so we went in for a sell entry, and then placing this trend line here, we got out when price breaks out of the descending trend line. I think that's pretty straightforward. So let's look at parabolic SAR. So kind of the same concept. Here you see when price moves below the parabolic SAR, it's typically giving us a bearish signal. So when price begins to move above the parabolic SAR, you can see that it's moving above it. It's even broken out of the top, the upper side of the indicator. Okay, so that's a sign that trend is going to change. Okay, chandelier and ATR, same concept as well. Price is moving below, giving us a bearish signal. Once price moves above or breaks above these indicators, then both of them are triggered and our stop loss, and we get out of the trade. So I think that's pretty straightforward because all of these concepts are pretty similar just by using different indicators so that you can kind of substantiate your analysis to show that, okay, price is really breaking out over here, the trend is really changing, so I should get out of the trade. Okay. In this example, so this is just another example. In this case, we have a fixed stop loss. You can see it's a fixed stop loss at the swing high. Our sell entry is here when price breaks below this line. And also it's moving below our moving average. Here's our take profits over here. So you can see instead of just leaving our stop loss here, which you can see is really far away from where price is currently at, by using a trailing stop loss, we can get out of the trade right when price breaks above this level here. Similarly, in this case, price is breaking out of this descending trend line. Stop loss is placed slightly above. Like we mentioned earlier, stop loss should be placed beyond, take profit should be placed before. So we're going in for a sell entry and going towards a take profit over here. Okay. Okay, now let's look at using breakouts as trading stop loss. So breakouts are usually high volatility events and price can spike up and reverse almost as quickly. So a stop loss will help you to manage risk, protect your capital, and a trading stop loss can help you to protect your profit like we've seen in the previous slides. Okay, so let's move on to our next technique. Okay, trend trading. So here's a super simplified breakdown of how trend trading works. Firstly, you want to identify your trend. So in a price movement of a currency pair. So this is typically done by analyzing historical price charts, and an uptrend is characterized by higher highs and higher lows, while a downtrend is characterized by lower highs and lower lows. Okay, so entry points. Once you have identify a trend, the next step is to find an entry point. So in an uptrend, you might look to enter a trade when the price has retraced or pulled back slightly from its recent high. So basically, you're anticipating that the trend will continue. But in a downtrend, you might look for a retracement before the price continues its downward movement. So next we have setting stop loss and take profit levels. So to manage risk, it's crucial to set stop loss and take profit levels. So stop loss is a predetermined price at which your trade will automatically close to limit potential losses if the market moves against you. So a take profit level is where you decide to exit the trade to lock in profits before the trade potentially reverses. Number 4, riding the trend. So once you're in the trade and the trend continues, you aim to stay in the trade as long as the trend remains intact. So basically, in this situation, you would be monitoring the price movement and adjusting your stop loss and take profit levels if needed. Or you might choose to use a trailing stop loss that we just went through as well. Lastly, exiting the trade. So this typically happens when the trend reverses. But yeah, trends don't last forever, so it's important to be vigilant and not get too greedy. And remember to decide to exit your trade and take your profits where possible. Practice analysis. So I think that's pretty self-explanatory, so I won't get into that. Okay. So pullback support and resistance. So these are pretty basic trading knowledge, I suppose. But basically, a pullback support is a strong level of support which breaks out from a previous resistance level, and price is now dropping back to visit it again. So pro tip is when a pullback support lines up with a Fibonacci level, it tends to be very powerful. Pullback resistance, on the other hand, works well when it breaks a significant swing low and then starts pulling back to it. Even better if there are multiple Fibonacci levels that line up with it. So here's an example. So you can see at the red area, price tested this level 3 times with multiple swing highs in line with one another. And once price breaks the red area, it becomes a pullback support level. Then we expect price to pull back or retrace this level, which you can see from the dotted arrows. And this is an example of a pullback resistance. So you can see once price breaks the level, it becomes a pullback resistance, and we expect price to retrace and pull back to the same level, like you can see from these red arrows. Okay, now pullback resistance. Here we have a swing low, and thus a possible support level. With price passing below the swing low support, it is now a pullback resistance. Okay, so if we see in the next slide, you can see that price actually pulls back to this resistance level. Yeah, and once it reaches and reverses off the pullback resistance level, it then becomes an overlap resistance level. Okay, which we will get into now. So overlap resistance occurs when price reacts off a particular level from the top and from the bottom. So the more times that it reacts off this area, the stronger the overlap area. This basically means that there are bulls and bears that are respecting that area, so it's important to take note of that. Okay, so here the pro tip is that if the overlap area lines up with other elements, such as Fibonacci or graphical elements, it will make it even stronger. So that's basically what we call the confluence areas. Yeah, that applies for any support and resistance level that you can find. If you can support it with your Fibonacci, your pivot points, your pivot point indicators, that would be even better. Okay, so here's an example. Basically, you can see how once price breaks below the support at 105.643, you can see how price retraced or pulled back to this resistance level and reversed off of it, making it now an overlap resistance. Okay, here's another example. So here we have a big swing high resistance level. Price surpasses this level and becomes a pullback support where we expect price to pull back to that level. So in the green areas over here, we see price retrace this level and actually bounce off perfectly. So once price bounces off the pullback support, it then becomes an overlap support. Okay, in our second example, we see two swing highs lining up. So we have a swing high resistance. So price has surpassed this level as well and making it a pullback support. Here we can expect price to retrace to that level, so you take note of the blue circles. Price bounces off this level twice, making it a strong overlap support. Okay. Okay. In this last example, we have multiple swing lows that are in line at the 33420 level. So once price breaks this level, it becomes a pullback resistance. We can see price has tested this level 3 times, 1, 2, 3 over here, making it a strong overlap resistance level. And then once price passes again, then it becomes a pullback support. And once it bounces off that level, it then becomes an overlap support. I think by now you guys have gotten it. So let's move on to our last technique. Okay, so how do you identify a trend? Okay, I briefly talked about this earlier. So how you can identify trends is obviously you can just look at the charts and you tend to be able to identify whether it's ascending or it's moving in a downtrend or whether it is ranging. But if you want to be extra certain, you can try looking for trend lines and trend channels. So what makes a valid trend line is if there are at least 3 significant touches. For an ascending trend line, the touches should be on the bottom and on, yeah, so if it's descending, then the touches should be at the top. So here's another example. Okay, you can see the touches on the bottom and here as well. For descending trend lines, it should be on the top and on the bottom, but same thing, we are looking for at least 3 significant touches. So you can see here we have about 4, and here we have about 4 as well. Okay, so watch out for at least 3 significant touches for it to be considered a valid trend line, like over here. Okay, and you can see on the 4th touch, price is playing the reaction. Okay, so let me know if you guys think that this trend line is valid or not in the chat. Okay, someone said that it's not valid. Yep, so it is not valid because we mentioned that if it's a descending trend channel or trend line, the touch has to be on the top and not on the bottom. Okay, so if we look at drawing valid channels, the valid channels are if there are at least 4 significant touches, 2 at the top and 2 at the bottom. Okay. Over here, this is an example of a descending trend channel. So it doesn't have to be consecutive like this or like this, but just as long as there are 2 touches. Okay, now let's look at the different indicators that you can use to identify the trend. Okay, so firstly is Ichimoku cloud. So breaking down the lines, it consists of several components and it's basically composed of 5 lines or calculations. 2 of which comprise a cloud where the difference between the 2 lines is shaded in. The lines include a 9-period average, a 26-period average, an average of those 2 averages, a 52-period average, and a lagging closing price line. So the cloud is a key part of the indicator. Okay, so let's look at breaking down the lines. So basically, when the price is below the cloud, the trend is bearish, or the signal over here is bearish. When price is above the cloud, the trend is up, or the signal is bullish. Trend signals are strengthened if the cloud is moving in the same direction as the price. So for example, during an uptrend, the top of the cloud is moving upwards, or during a downtrend, the bottom of the cloud is moving down. Okay, so let's break down the different lines. Okay, we have the Tenkan-sen or conversion line, and this is the average of the highest high and the lowest low over the past 9 periods. The Kijun-sen or baseline is the average of the highest high and lowest low over the past 26 periods. Chico's span or lagging span is the current closing price plotted 26 periods behind the current time. And Senko span A or leading span A is the average of the Tenkan-sen and Kijun-sen plotted 26 periods ahead of the current time, used as a leading indicator of the trend. Okay, Senko span B or leading span B is the average of the highest high and lowest low over the past 52 periods, plotted 26 periods ahead of the current time, used as a leading indicator of the trend. Okay, explaining the lines. So the first way to use Ichimoku is to identify trends. Basically, the Tenkan-sen and the Kijun-sen. Tenkan-sen is the one in blue, Kijun-sen is the one in red. Those are used to identify the trend of the market. So a bullish trend occurs when the Tenkan-sen is above the Kijun-sen, and a bearish trend occurs when the Tenkan-sen is below the Kijun-sen. Okay, you can also use your Ichimoku indicator to determine support and resistance levels. Okay, now the third way to use Ichimoku is for confirmation. So the Chico span is used to confirm the signals that's generated by the other lines. And if the Chico span is above the current price, it confirms a bullish trend. If the Chico span is below, then it confirms a bearish trend. Okay? So Ichimoku generates buy and sell signals based on positions of the various components. So for example, a buy signal is generated when the Tenkan-sen crosses above the Kijun-sen and Senko span. And a sell signal is generated when the Tenkan-sen crosses below the Kijun-sen. Okay, so how can you effectively use this indicator? So basically, the overall trend is up when the price is above the cloud, and down when the price is below the cloud. Yep, and trendless or transitioning when the price is within the cloud. Okay, so of course you can also use support and resistance, as we mentioned earlier. So yeah, so you can see when price is moving below the cloud, it is bearish. When price is moving above the cloud, then it's bullish. Within the cloud is typically transitioning. Okay, another way is price and MA cross. So if you're a beginner, this is a great way to identify moving averages of different periods to analyze price movements and generate buy or sell signals. I won't get into it, but yeah, this strategy basically captures trends and works best in trending markets. Next, we have the Golden Death Cross, which is a strategy based on the intersection of two important moving averages on a price chart. Okay, so I'm not going to explain how the indicator works, but basically, when you see a golden cross, it's a bullish signal. When you see a death cross, then it's a bearish signal. Okay, channels as well. Can see when price hits the the sides of the channel, that's typically a sign that price is reversing off of the channel. Okay, so when you are deciding which settings to use for your moving averages, try and make sure that it touches the bottom of the bottom or the top of the price as much as possible. Same for natural moving averages. And a double break is basically when price breaks below the moving average as well as your trend channel. So basically, as I mentioned earlier, when you have an analysis, you want to try and make sure that you use different indicators to support that analysis. Okay? Yep, so that's what we call confluence. You can see in this case, we are using a trend channel, Ichimoku, as well as moving average, as well as your death cross. Okay, you can see we see this price moving upwards. Okay, so to wrap things up, we'll quickly go through the disadvantages of trend trading. So basically, it can give you false signals, late entries, some choppiness as well, whipsaw trades, which basically means that traders enter and exit positions quickly due to volatile price movements, which can result in losses. Limited profits in ranging markets, and it might require timely decision making. And lastly, noisy price data. So to overcome it, you want to make sure that you have all of these in check. And how you can make sure these are in check is by basically making sure that you use a trading journal so that you can track your trades, track your strategies to see what works and what doesn't. Okay, and this is just to show you guys what an unclear market structure looks like on a 15-minute time frame. You can see it's pretty messy. There's no clear price movements. But when we change to 1 hour, you can see it's pretty clear. Okay, so yeah, so this is just a kind of a rule of thumb to live by. So if the clearer the swing low, the clearer the swing high, the clearer the trend between these 2 points, the more accurate your analysis will be. Okay, that brings us to the end of my slides. Thank you guys so much for joining me today. I hope you guys found this helpful. And yeah, have a great rest of your week, and I'll see you guys next week. Bye, everyone. Thanks, everyone. Bye.